Have you ever noticed something strange during market crashes? While everyone else is panicking, checking their portfolios obsessively, losing sleep over their retirement accounts, there's a group of people who seem almost calm. I'm talking about truly wealthy people, the ones with serious money. They're not refreshing their brokerage apps every 5 minutes. They're not calling their financial advisors in a panic. They're not selling everything and hiding cash under their mattress. In fact, they're doing the opposite. They're buying. They're calm. Some of them even seem excited. Here's what nobody talks about. Rich people don't have ice in their veins. They're not emotionless robots. They're not smarter than you. They just understand something about market crashes that most people completely miss. Here at Simple Money, we've watched how different groups of people react during market downturns. And today, I'm going to reveal exactly why wealthy people don't panic when markets crash. More importantly, how you can develop the same mindset starting today. Because here's the thing. The difference between people who panic and people who profit during crashes isn't about how much money they have. It's about how they think about money. And that's something you can learn right now. Here's what's really happening during a market crash, and why most people get it completely wrong. When the market drops 20%, 30%, or more, most people see their portfolio value shrinking. They log into their account, they see red numbers everywhere. They see their net worth dropping by thousands or tens of thousands of dollars. And their brain does what brains are designed to do. It panics. It screams danger. It says, get out now before you lose everything. This feels like a rational response. Your wealth is disappearing. Of course you should do something to stop the bleeding. Of course you should sell before it gets worse. But here's where it gets interesting. That feeling, that panic, that overwhelming urge to do something, that's the exact moment when most people destroy their financial future. Think about it this way. Imagine you own a rental property. You bought it for $300,000. It generates steady rental income every month. Good tenants. No problems. Then one day, your neighbor sells their identical house for $200,000. A bad sale. They needed cash fast. They took a lowball offer. Does that mean your house is now only worth $200,000? Does that mean you should panic and sell your house immediately before it drops even more? Of course not. That would be insane. Your house is still the same house, same location, same rental income, same fundamentals. Nothing actually changed except one panicked seller next door. You'd probably think, wow, that was a bad sale. Glad that's not me. And you'd keep collecting rent like nothing happened. But when the stock market does the exact same thing, people panic and sell. They see other people selling at low prices and they think, I better sell too before it gets worse. The house didn't change, the stocks didn't change, the businesses didn't change. Only the price changed. And yet, people treat dropping stock prices like an emergency and dropping house prices like an opportunity. That's the disconnect wealthy people understand. Price and value are not the same thing, and confusing the two costs most people a fortune. The first thing wealthy people understand that others don't is what I call the business reality principle. And once you get this, market crashes stop being scary and start being obvious. Here's the core insight. When you own stock, you don't own a number on a screen. You own a piece of an actual business. A business with employees, customers, products, and revenue. Most people forget this completely. They see stocks as gambling chips, numbers that go up and down randomly. Things you trade trying to time the market. But wealthy people see stocks as ownership stakes in real businesses. When the stock market crashes, they ask themselves one simple question. Did the businesses actually get worse? Let me give you a specific example. During the 2008 financial crisis, the stock market dropped about 50%. Absolute carnage. People lost their minds with panic. But here's what actually happened to the businesses. Companies like Apple were still making iPhones, Coca-Cola was still selling soda, Johnson & Johnson was still selling Band-Aids, Microsoft was still selling software. Sure, they might have had slightly lower sales during the recession, but they didn't suddenly become worthless. They didn't stop operating. They didn't cease to exist. The businesses were still fundamentally sound. They were still generating revenue and profits. They were still valuable. Only the price people were willing to pay changed. Wealthy people saw this clearly. They owned pieces of real businesses. Those businesses were still operating, still valuable, The price drop was temporary panic, not permanent destruction. So they didn't sell. Many of them bought more. Because they understood they were buying ownership in real businesses at discount prices, not gambling on numbers. Here's why this matters so much. If you see stocks as businesses, a market crash is a sale. Like Black Friday for ownership stakes in great companies, you get excited, not scared. If you see stocks as gambling chips, a market crash feels like losing. Like the casino is rigged. You panic and try to salvage what you can. Same event. Completely different mental frame. Completely different action. Completely different outcome. I watched someone live this during the 2020 COVID crash. The market dropped about 35% in a month. Fastest crash in history. Total panic everywhere. This person owned index funds, broad exposure to the whole market. During the crash, they kept asking themselves, did American businesses suddenly stop being valuable? Did Apple stop making phones? Did Amazon stop shipping packages? The answer was obviously no. If anything, some businesses became more essential during lockdowns. So they didn't sell. They actually kept buying through the whole crash. Within a year, the market had fully recovered and hit new highs. They'd accumulated shares at massive discounts. Their wealth grew significantly because they understood the business reality principle. Meanwhile, people who sold during the panic locked in losses and missed the recovery. Same crash. Opposite results. The second thing wealthy people understand is what I call the timeline advantage, and this might be the most important wealth-building concept there is. Here's what I mean. Wealthy people invest with timelines measured in decades, 10 years, 20 years, 30 years or more. They're not trying to make money next month or next quarter. Most people invest with much shorter timelines. They think in months or maybe a few years. They want results soon. They check their accounts constantly. They react to short-term movements. That difference in timeline completely changes how you experience market crashes. Think about it this way. If you need your money next month, a 20% market crash is a disaster. You might have to sell at a loss. You're trapped. You're in real trouble. But if you don't need that money for 20 years, a 20% market crash is barely a blip. It's noise. It's irrelevant to your actual timeline. Wealthy people have long timelines because they have money they don't need to touch for decades. That gives them a massive psychological advantage during crashes. But here's what makes this so powerful. Even if you're not wealthy yet, you can create the same timeline advantage. If you're investing for retirement and you're 30 years old, you have a 30-year timeline. That's longer than most rich people's timelines. The difference is whether you act like it, whether you actually invest based on your real timeline or your emotional timeline. Let me show you why timeline matters so much with real numbers. Since 1926, the stock market has had positive returns about 75% of the time over one-year periods. That means 25% of the time, you lose money in any given year. Those odds are okay, but not great. No wonder people panic during down years. 1 in 4 years, you're losing money. But look at longer timelines. Over 10-year periods, the market has been positive 94% of the time. Over 20-year periods, it's been positive 100% of the time. Every single 20-year period in market history has made money. The longer your timeline, the more certain your success becomes. Crashes become irrelevant. Volatility becomes noise. You literally cannot lose if you hold long enough. Wealthy people know these numbers. They know crashes are temporary and growth is permanent over long timelines, so crashes don't scare them. Crashes are just part of the ride. I know someone who started investing in 2000. Terrible timing. The market proceeded to crash twice over the next decade. Dot-com bubble burst. Financial crisis. Brutal. But they kept investing consistently. They had a 30-year timeline. They ignored the crashes, just kept buying every month through good times and bad. Today, more than 20 years later, their portfolio has grown by over 400%. Those crashes that felt devastating at the time, tiny blips on the long-term chart. That's the timeline advantage. When you extend your timeline, crashes lose their power over you. The third thing wealthy people understand is what I call the opportunity inversion, and this is where things get really interesting. Here's the concept. Most people see market crashes as threats. Wealthy people see market crashes as opportunities. Same event, opposite interpretation. Think about how you react to sales in normal life. Store has a 50% off sale. You get excited. You think, great, I can buy things I wanted at half price. This is awesome. But when the stock market goes on sale, people panic. Stocks are 50% off. Instead of thinking that's a great deal, people think something must be wrong. Better stay away. It's completely backwards. The exact same discount psychology that makes you excited at a store makes you terrified in the market. Wealthy people have trained themselves to invert this response. When stocks go on sale, they get excited. They see opportunity. They think, great, I can buy ownership in great businesses at half price. This isn't just theoretical. This is how massive fortunes get built. Warren Buffett's famous quote is, "Be fearful when others are greedy, and greedy when others are fearful." That's opportunity inversion in action. When everyone panics and sells, that's when you buy. When everyone's excited and buying, that's when you're careful. Here's a specific example of how powerful this is. During the 2008 crash, quality stocks were trading at absurd discounts. Companies with strong fundamentals, solid businesses, decades of profitability, trading at 50% or more below their peak values. Wealthy people saw this as the opportunity of a lifetime. They moved cash from bonds into stocks. They bought great companies at bargain prices. They deployed capital aggressively. What happened? Those investments doubled, tripled, quadrupled over the next decade. People who bought during the panic became significantly wealthier. People who sold during the panic locked in losses. Same crash. Opposite actions, completely different outcomes, all because of how they interpreted the event. But here's what makes opportunity inversion so hard. It requires you to act against your instincts. Your brain sees everyone panicking and thinks, they must know something I don't. I should panic too. That's herd mentality. That's social proof. That's your brain trying to keep you safe by following the crowd. In nature, following the crowd usually keeps you alive. But in markets, following the crowd keeps you poor. Because the crowd panics at bottoms and gets greedy at tops. The exact opposite of what works. Wealthy people have learned to override this instinct. They've trained themselves to feel excitement when their brain says panic. They've inverted the natural response. I watched someone do this during the 2020 crash. While everyone around them was selling and panicking, they felt physically sick doing it, but they kept buying. Every week, buying more stocks as prices fell. They told me later it felt horrible. Everything in their brains screamed that they were making a mistake, but they'd learned to recognize that feeling as a signal. If it feels terrible to buy, that's probably the right time. 6 months later, they'd made more money than in the previous 3 years combined, because they inverted the opportunity when everyone else followed their instincts. The fourth thing wealthy people understand is what I call the diversification safety net, and this is what gives them the confidence to stay calm when others panic. Here's the principle. Wealthy people don't bet everything on individual stocks or market timing. They diversify broadly across many investments. That diversification creates emotional stability during crashes. When you own 1 or 2 stocks, a crash is terrifying. What if those specific companies fail? What if you picked wrong? You have concentrated risk and therefore concentrated anxiety. When you own hundreds or thousands of companies through index funds, a crash is less scary. You're not betting on specific companies, you're betting on the entire system. On capitalism itself, on human innovation and productivity. That's a much safer bet, much easier to stay calm about. Think about it this way. Imagine you own just Tesla stock. The market crashes and Tesla drops 50%. You're terrified. Did you pick wrong? Is Tesla doomed? Should you sell? Now imagine you own a total market index fund. The whole market drops 20%. You're much calmer. You're not worried about picking wrong. You own everything. You're diversified. The market dropping 20% doesn't mean capitalism failed. It doesn't mean human productivity stopped. It means prices are temporarily low. That's much easier to handle emotionally. Diversification isn't just about spreading risk. It's about creating psychological stability that lets you make good decisions during chaos. Wealthy people understand this deeply. They're not trying to pick winners. They're not betting on individual companies. They're diversifying broadly and trusting the long-term growth of the overall system. That's why they can stay calm. They're not worried about being right about specific bets. They're confident in the long-term trajectory of diversified markets. Here's a real example. I know someone who had $100,000 invested, but they'd put 80,000 of it into tech stocks and 20,000 into everything else. When tech crashed in 2022, they panicked. Their tech holdings dropped 40%. They lost $32,000. They sold in panic, locking in losses. If they'd been diversified across the whole market, the same crash would have only cost them about $15,000. Much less painful, much easier to hold through. Plus, a diversified portfolio would have recovered faster as different sectors rebounded at different times. The person realized their mistake. They reinvested in broadly diversified index funds. Now, during market volatility, they stay calm. Because they're not worried about being right about sectors. They own everything. That's the diversification safety net. It's not just risk management, it's emotional stability management. The fifth thing wealthy people understand is what I call the cash cushion confidence, and this might be the most overlooked wealth-building principle. Here's what I mean. Wealthy people can stay calm during market crashes because they have cash reserves outside the market. 6 months of expenses, a year, sometimes more. This changes everything psychologically. When the market crashes, they don't need to sell to pay bills. They're not forced to lock in losses. They can ride out the storm comfortably. Most people don't have this cushion. They have some savings, sure, but not enough to feel truly secure. So when the market crashes, they worry. What if I lose my job? What if I need this money? What if it gets worse? That worry drives panic selling. They sell not because they want to, but because they feel they might need to. They're selling from fear of future necessity. Wealthy people don't have that fear. They know they have plenty of cash. They could go years without the market recovering and be fine, so they can afford to wait, to be patient, to stay invested. The cash cushion creates emotional freedom. Freedom from fear, freedom from pressure, freedom to make good long-term decisions instead of panicked short-term ones. Here's why this is so important. The worst thing you can do during a market crash is be forced to sell. Maybe you lose your job during a recession. Maybe you have an emergency. If you're forced to sell stocks at the bottom to cover expenses, you've crystallized losses at the worst possible time. But if you have cash reserves, you never face that situation. You cover emergencies with cash. Your investments stay invested. They recover naturally when the market rebounds. This is why wealthy people obsess over liquidity. It's not about hoarding cash. It's about buying emotional freedom and decision-making power during crises. I watched this play out during 2020. 2 people, similar portfolios, both down about 30% during the crash. Person A had minimal cash savings, maybe 2 months of expenses. When the crash happened, they panicked. They worried about their job. They worried they might need the money. They sold at the bottom out of fear. Person B had a year of expenses in cash savings. When the crash happened, they were calm. They knew they were covered no matter what. They didn't need to sell. They held through and recovered everything plus gains. Same crash, same portfolio, but person B had the cash cushion confidence that person A lacked. That confidence was worth tens of thousands of dollars. That's why building cash reserves is just as important as investing. The cash creates the psychological stability that lets you stay invested during chaos. But here's what nobody wants to admit, and this is where things get really uncomfortable. The reason most people panic during market crashes has almost nothing to do with what's happening in the market. It has everything to do with what's happening in their bank account. People don't panic because stocks drop 20%. They panic because they're financially fragile. They're living paycheck to paycheck or close to it. They don't have a cash cushion. They don't have job security. They're one emergency away from disaster. So when the market crashes, it's not really about the market. It's about their underlying financial anxiety suddenly getting amplified. The crash becomes a trigger for all their existing financial stress. Wealthy people don't panic because they're not financially fragile. They have margins, they have cushions, they have options. A market crash doesn't threaten their immediate security because their immediate security doesn't depend on their portfolio value. This is the uncomfortable truth. You can't think like a wealthy person about market crashes until you build the financial foundation that makes that thinking possible. You need the cash cushion. You need the diversification. You need the long timeline where you don't need the money soon. You need the stability. Without those foundations, staying calm during a crash isn't about mindset. It's about pretending, and your brain knows the difference. This is why financial education alone doesn't work. You can learn everything about market crashes, understand intellectually that you should hold through volatility, and still panic when it happens. Because knowing what to do and being able to do it are completely different. Being able to stay calm requires building the actual financial structure that makes calm rational. The knowledge comes second. The foundation comes first. Let me tell you about two people who experienced the same market crash in completely different ways. I'll call them Alex and Jamie. Alex had been investing for about 3 years. They'd built up a portfolio of about $50,000, all in stocks, mostly tech-focused. They were excited about investing, checking their account daily, following market news obsessively. They had about $5,000 in savings. Not nothing, but not a lot. One paycheck covered their bills with a little left over. They had some credit card debt. Nothing unmanageable, but it was there. When the market crashed, Alex watched their portfolio drop from $50,000 to $35,000. $15,000 gone in weeks. They were devastated. Alex couldn't stop thinking about it. They refreshed their portfolio constantly. They read every article about the crash. They catastrophized, imagining it getting worse and worse. They lost sleep. They were stressed at work. They felt sick. Finally, they couldn't take it anymore. They sold everything. Got out of the market completely, moved to cash. They told themselves they'd get back in when things calmed down, when the coast was clear, but by the time things felt calm, the market had already recovered. Alex had sold at $35,000, and it felt too expensive to buy back at $48,000. They'd missed the recovery. They eventually got back in, but had permanently lost over $10,000 by selling at the bottom. Plus, they'd put themselves through weeks of emotional torture. Now let me tell you about Jamie. Jamie had a similar portfolio, also about $50,000 invested. But Jamie's overall financial situation was different. Jamie had $18,000 in a savings account, 6 months of expenses. They'd spent 2 years building that cushion before investing heavily. They had no debt. They lived below their means. Jamie's portfolio was diversified across the total market, not concentrated in tech. And critically, Jamie had decided when they started investing that this was retirement money with a 30-year timeline. When the market crashed, Jamie's portfolio also dropped from $50,000 to about $38,000. $12,000 gone, same pain, same red numbers. But Jamie's response was completely different. They looked at the drop and thought, "That's painful to see. But I don't need this money for 30 years. Did companies stop being valuable? No. Are people still working, creating, innovating? Yes." Jamie felt anxious, sure. But they also felt secure. They had 6 months of cash. They had a job. They had no debt. They weren't financially fragile. The market drop wasn't a threat to their actual life. So Jamie didn't sell. They didn't even stop their automatic monthly investments. They just kept buying through the whole crash, accumulating shares at discount prices. A year later, Jamie's portfolio was worth $72,000. They'd actually made money through the crash by staying calm and continuing to invest. The difference between Alex and Jamie wasn't intelligence. It wasn't luck. It wasn't even how much money they started with. The difference was foundation. Jamie had built the financial structure that made staying calm possible. The cash cushion, the diversification, the real long-term timeline, the financial stability. Alex had skipped those foundations and jumped straight to investing. When the crash came, they had no structure to support them, so they panicked. Here's what most people don't realize, and this is the key insight that changes everything. Staying calm during market crashes isn't a personality trait. It's not about being brave or unemotional or having nerves of steel. It's about having the right structure in place before the crash happens. Rich people don't panic because they're different humans than you. They don't panic because they've built the financial foundations that make panic unnecessary. They have cash cushions so they're not worried about immediate needs. They have diversification so they're not worried about specific bets being wrong. They have long timelines so they're not worried about short-term volatility. They understand they own businesses, not numbers, so price drops feel temporary. All of that is learnable. All of that is buildable. None of it requires being wealthy first. You can start building those foundations today. Build your cash cushion first. 3 months of expenses, then 6. Get that security before you invest heavily. Diversify broadly. Don't try to pick winners. Own everything through index funds. Remove the anxiety of being right about specific bets. Clarify your real timeline. If you're investing for retirement decades away, write that down. Remind yourself during crashes. You have time. Understand what you're actually buying. You're buying ownership in real businesses, companies that create products and serve customers and generate value. Not lottery tickets, not gambling chips, real ownership. Those foundations create the psychological stability that looks like confidence from the outside. But it's not really confidence, it's structure. When you have structure, you don't need to be confident or brave during crashes. You just need to follow your plan. And following a plan is way easier than being brave. The wealthy know this. They've built the structure over years or inherited it. You can build it too. It just takes time and discipline. Start with the foundation. Build the cash cushion. Diversify properly. Clarify your timeline. Then when the next crash comes, and it will come, you won't panic. Not because you're brave, not because you're smart, but because you built the structure that makes panic unnecessary. You created your own timeline advantage, your own cash cushion confidence, your own diversification safety net. That's how rich people stay calm during crashes. They have structure, and structure is available to anyone willing to build it. The business reality principle, the timeline advantage, the opportunity inversion, the diversification safety net, the cash cushion confidence. These aren't secrets. They're not magic. They're just financial foundations that create psychological stability. Foundations that let you make good long-term decisions instead of panicked short-term ones. You can build these foundations starting today. Not all at once. One piece at a time. First the cash cushion, then the diversification, then extending your mental timeline, then training yourself to see drops as opportunities. Each foundation you build makes the next crash a little less scary, a little more manageable, until eventually, you're the calm one while everyone else panics. That's not years away, that's available to you right now. The question isn't whether you can develop the same mindset as wealthy people during crashes. The question is whether you're willing to build the foundation that makes that mindset possible. Start building today, because the next crash is coming. It always is. And when it does, you want to be the person who stays calm, who sees opportunity, who builds wealth while others panic. Not because you're different, but because you built different. Because you created the structure that turns panic into patience, that turns crashes into opportunities, that turns volatility into wealth. That's available to you, starting right now. The only question is whether you'll build it before you need it.